Today we'll be reviewing Chapter 10 of the Self-Directed IRA Handbook. A promissory note is the legal obligation between an IRA and a borrower. I want to start off with a brief overview on the requirements of a note. I'll go into more depth on each requirement later on in the video. The terms of a promissory note will indicate at minimum the amount loaned, the interest rate charged, the monthly payment amounts, and the due date of the loan. The steps to create a promissory note are as follows. First, the IRA owner creates the promissory note, preferably with an attorney or a title company. Second, the borrower signs the note and any other related documents such as the deed of trust or mortgage. And finally, the IRA owner instructs us to fund the loan. A promissory note may have monthly payments of interest, amortizing payments, which are payments of principal and interest, or it may instead have one lump sum payment due at the end of the note, which is known as a balloon note. This balloon note would typically have a shorter term. Payments are sometimes received and processed by a third-party payment processor. The servicer in this case would receive and track the payments from the borrower, then send them to the self-directed IRA custodian for deposit into the IRA. The servicer can also send missed or late payment notices to the borrower and charge fees for late payments if the note states that is permissible. One thing to keep in mind is that the IRA owner should never receive the payments for the IRA, since the IRA owner cannot deal with the income or assets of his or her IRA. For an interest rate on a note to be in compliance with the exclusive benefit rule, it must be commercially reasonable. But what does that mean? The EBR means it must be based on an arm's length transaction and must be at a fair market value. For example, an interest rate of 1% would not be acceptable because it isn't an interest rate that a borrower could walk into a bank and obtain. A loan at 20% that is fully secured against real estate property could also potentially violate this, since a rate that high could exceed the current rates in the market. It's important to just remember that excessively low and excessively high rates are suspect and would be something we want to question as a custodian. At minimum, a promissory note should include the following things: the amount being loaned, the starting date of the loan, the monthly payment amounts, the maturity date or due date, which must be an actual date in the future, the interest rate being charged and type of rate, such as annual, simple, or compounded. It's also sometimes helpful for us if the client can give us an amortization schedule for interest and principal payments so that we can apply those payments properly. It should always have the full legal name of the borrower, and if the borrower is a company, we would want the articles of organization and certificate of good standing. It might be beneficial to get a personal guarantee from the owners of the company, as that further protects the lender in cases of default. The lender should always have their Madison Trust titling as their name. They'll typically have a default clause stating what happens if the borrower does default. They might have an acceleration clause, which allows the lender to call the entire note due if the borrower defaults. There'll most likely be attorney and collection fees, allowing the lender to recoup expenses incurred in collecting on a default loan. The place of payment, which for us would be our Montvale address. It would have any late payment fees or penalties. And if the loan is secured, we would need the description of collateral which is securing the loan. A deed of trust or a mortgage should be included when the loan is secured by real estate. The lender should obtain a loan application from the borrower and collect the borrower's social security number, date of birth, addresses, income, and assets, as this information is vitally important in the event of default because it will assist in collection efforts. Any loan document drafting fees and title insurance costs that protect the lender should be paid by the borrower at closing. And finally, we would need the borrower to sign and notarize the note. When drafting the promissory note, the IRA owner should work with an attorney or a title company who is experienced in private lending transactions such as promissory notes, because there are laws that apply to loans and the IRA owner needs to ensure that the loan is drafted properly to be in compliance with these laws. For example, California has a usury law, which restricts the interest charged on a loan to a maximum rate of 10% annually. There are exceptions, such as if the loan is arranged by a broker and secured by real estate. However, because of the strict compliance requirements, an IRA owner should always seek guidance of competent professionals when drafting these notes and other loan documents. A secured promissory note is a loan where the borrower pledges certain assets to the lender as collateral for the loan. Typically, this would be real property or something of that kind. The borrower would place a lien against the title by using a deed of trust or mortgage, and if the borrower defaults, the lender can sell the collateral or foreclose on the property to satisfy the amounts owed on the note. Some states only allow mortgages, and some states allow for deed of trusts. Both do the same thing and secure the lender against default. However, under a mortgage, the lender must go to a court to enforce the default, whereas under a deed of trust, the lender can foreclose after giving certain notices to the borrower. Regardless of whether the IRA is obtaining a deed of trust or a mortgage, it is the IRA owner's responsibility to understand what other liens are already recorded on the title, since prior liens recorded have priority to collect under default. Therefore, it's again best for the clients to work with a title or escrow company when preparing these promissory notes. Promissory notes can also be secured by personal property of the borrower, such as equipment or stock. We've even seen things as strange as cattle. To go about this, there would need to be a security agreement and a UCC-1 filing. The security agreement is a contract between the borrower and lender that outlines the property being secured by the promissory note. It states the process in which the IRA would go about taking the property from the borrower upon an event of default. The UCC-1 filing is a document signed by the borrower and filed with the Secretary of State where the property and/or borrower is located. This form should identify the borrower, the loan, the secured party, and the property subject to the UCC-1 lien. Another type of promissory note is an unsecured note, which is basically a loan that is not secured by any real or personal property of the borrower. These are far more risky investments and as a result should only be pursued after the IRA owner has properly analyzed the borrower's ability to repay the loan. We must do our due diligence when reviewing promissory note documents to ensure that the note wouldn't be considered a prohibited transaction. A per se prohibited transaction occurs when an IRA lends money to a disqualified person, for example, their daughter or their spouse. A self-dealing prohibited transaction can occur when a disqualified person to an IRA benefits from an IRA's loan. The last type of note would be a profit or equity participation promissory note. Under most promissory notes, the amounts payable is the principal amount of the loan and the interest. However, some loan investments contain clauses where the lender is also entitled to a share of the profits from the borrower's business. This is known as share of profits. Another variation occurs when, in addition to the flat rate of interest, the lender is entitled to a share of the appreciation that occurs on a property acquired by the borrower with the loan. This is known as a share of appreciation. Let's look at an example. An IRA loans a company $100,000 at 6% annual interest. The company is a new clothing company using these funds to purchase new inventory. In addition to them paying interest, it also agrees to pay the IRA 10% of its profits for the first year of the loan. This means that they would owe $6,000 from interest and $20,000 in profit sharing. The profit sharing would be considered ordinary income and would be required to pay UBIT tax. A final overview of the chapter reminds us that a self-directed IRA can loan money to a non-disqualified person as an investment, which is known as a promissory note. The loan from the IRA may be either unsecured or secured by real estate or other assets. Unsecured loans can be very risky since there is no recourse if the borrower defaults. And equity participation notes are when an IRA gets a share of profits from a loan, which can result in UBIT tax. Back to you, Mr. Gleish.